Today is Tuesday, the day before Fed Day, and we're going to go through a new report put out by Goldman Sachs. People have been talking about Indian gold demand, and we're going to try and put a nice frame around it for you all. We'll also be discussing oil. All right, the title, tentatively, India wants the gold. A play on the they want the gold concept because this is India doing it, and they're following in the footsteps of China. Let's take a look at what that is about. While we do that, we'll check the markets first. You're looking at oil there. 10-year yields are up 3 at 443. The dollar is 106.98, up 12. SP 500 is 60.54, down 16. VIX is 15.01, up 32. Gold is 26.43, down 9 and change. Silver is 30.29, down 22. Copper is pretty weak, down 5 cents at 4.10 roughly. WTI 69.85, down 81, also pretty weak. Natural gas 312, up a penny. Bitcoin 107, 107 spot O, up almost 900. Ethereum over 4,000 now at 4011, up 24. Palladium 933, down 12. Platinum 933, down 460. Well, there we are. We're back to parity. I guess I should start paying attention to that. Gold, silver 87 and change, firm, stable. Soybeans 980 unchanged offered, corn 434 unchanged bid, and wheat not 554 plus 3. The more volatile market is wheat now, geopolitically, I guess speaking. You can't really grow wheat everywhere. You can grow soybeans in most of the world. So, all right, where were we? Oh yeah, there we were. All right, front page. Goldman Central Bank's China doubles down on OTC gold buying. That's a report a couple days ago, which we elaborated on, covering the surprise demand coming out of China through the OTC London/Switzerland market. Today's report also happens to be from Goldman. It's a nice little dry analysis of what's going on in India, and we're going to put that in a frame for gold investors. Beware, bullion banks are out of the penalty box. As we said on Sunday and yesterday, bullion banks are out of timeout. They've been good boys. The election is over, and now they're going to play the game. The question is, how much of an influence will they exert on the market? Will they go back to the bearish bias, or will they be a little bit more balanced in their approach to market making? And the answer to that is, what are the producers doing? And we don't know what the producers are doing yet. But if the producers have flow to sell to hedge, well, then the banks will go back to being bearish biased. I don't think the producers have much to sell, with everyone taking it offline and the missing gold from earlier in the year, which we reported on. All right, here we go. Let's start with oil, because we're going to continue that in the premium section at the bottom, because there's a trade setting up. We're not sure of it yet, but it's a nice little clean setup, so you can make your own decision as to how you want to do it, if you want to do it, and it applies to every market as well. So here we go. Oil getting ripe to rally. Oil recently has been inching higher despite bearish Chinese demand backdrop. Why? Well, maximum pressure on Iran is the signal from Trump. Right, this is a quote from SEB. Last time Donald Trump was president, he drove down Iranian oil exports to close to zero as he exited the JCPOA Iranian nuclear deal and implemented maximum sanctions. A repeat of that would remove all talk about a surplus oil market next year. That's been in the market. There's a lot of extra oil, blah, 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 right? Leaving room for the rest of OPEC Plus as well as the US to lift production a little. Okay, so that's the fundamental backdrop, if you want to call it that, the administrative backdrop. This is from a report by Deutsche Bank on commitment of traders. Now, we like to see events that are potentially biased in one direction, lines of demarcation, and we like to see where investors are. Now, on the far right is oil. And just speaking simply about it, oil speculators, small ones and big ones, are net short as they've not almost ever been, but close to it. All right, so there's a little bit more room for them to sell, but they're very lopsided short. And moving to the left, copper is just starting to get short. Silver is coming off the highs, and gold on the far left there is not near the highs, but it's pretty high. So don't look at those numbers and say, oh, that's everyone's long gold. That's how it works. Gold is generally long all the time. We're near the top end, but it's not the longest it's ever been. Okay, so back to oil. There are a lot of shorts in oil, and we think that there's a trade to do based on that. We're going to discuss the trade and the trigger for that in premium. Moving to the main event, Goldman notes India's gold imports surged to an all-time high in November. That's an all-time high. That is not necessarily monetary gold. That is gold purchased by Indians for their own consumption. All right. Starting with a quick backdrop, because it's going to help a lot explain, because the new high, the all-time high in November, eclipses the one made just in August. So it's not like it's going back 20 years, but it's significant. All right. In August of this year, Goldfix wrote, since 22, India's gold demand has not appreciably fluctuated with gold price, whereas before 22, it fluctuated frequently and usually in line with gold price changes. This change signals inelastic demand at a higher price, replacing elastic demand at different prices. Now, in English, price is no object for Indians. Now, this is the central bank, as well as this is a combination. And here's you're looking at in this chart. This is the backdrop for what just happened. India has been buying the same amount of gold. In the red rectangle, that's tonnage. The same tonnage of gold despite the price. The price is low, this is how many tons we're going to buy. The price is high, this is how many tons we're going to buy. That's like not having a budget, right? How many Porsches are you going to buy? Well, how much money did you make this year? Porsche is a luxury item. Gold is viewed as a luxury item, so you would buy it. You would buy less of it when you had less money. On the other hand, if you could print your own money, you'd buy as many Porsches as you wanted. Now, India does print its own money, and they're forcing incrementally gold to go up against the dollar by printing rupees and buying gold, regardless of the price. Indian demand is inelastic, and all that implies in your economics books. That's the backdrop. Now, Goldman Sachs' report today says the following. We are currently tracking gold imports at 59 billion in January through November 2024, 48% year over year higher than the same period a year ago on the back of stronger than expected festive demand. That's always the reason, and it's not untrue. Here's our edit. In July of 2024, the Indian government significantly reduced import duties on gold, lowering the total customs duty from 15% to 6%. That's why the festive demand was even higher this year. We'll show you that little chart down there. We'll make it big for you in a minute. This marked the most substantial reduction in over a decade in tariffs. Going back to Goldman, we must raise our forecast for gold imports to 65 billion versus 15 billion earlier for calendar year 2024. Based on current tracking estimates, we raise our gold imports forecast for calendar year 2024 by 15 billion, 0.4% of GDP. Note, it's in GDP. You measure gold imports in GDP, not FX reserves. That's bullshit. Okay, you measure in how much they can afford to buy, not how much they're holding on demand. That's FX nonsense. We're looking at economics here. All right. Gold imports surged to all-time highs in November. The chart. Here we go. November gold imports, 15 billion, right? August was the previous high at 11. What's that, 10 and a half, 11? The obvious thing here is that gold demand is going up, and there are several ways to look at or to answer why. And one reason is, they want the gold. Putting a finer point on it, Uh, when India lowered tariffs on gold in July, look at what happened in August, right? Gold is cheaper to them. They buy it September and October. Everybody's kind of saving their money. And then the holiday season, Diwali, starts to ramp up. And so the gold buying comes in even more. So, I don't want to get ahead of myself here. To put a little bit of a finer point on it, will this continue? Most likely, yes, with seasonal exacerbations, as previously noted, in India's demand for gold turns inelastic. In August, we said that. All right, Goldman's bottom line, and this is important if you're trying to figure out why does the retail Indian matter? Well, the retail Indian doesn't matter normally because they're just the retail buying, right? And they buy every year. We know that, and that's how their economy is doing, et cetera, right? That's why retail doesn't matter. All right. And Goldman's bottom line is India's merchandise trade deficit rose to an all-time high of 37.8 billion in November as gold imports scaled new all-time highs at 14.8 billion, likely driven by strong festive demand aided by the reduction in import tariffs on gold earlier in July, as we just mentioned. Now, Goldman frames it that way because gold is a merchandise that Indians are buying. And so you say, well, that's not monetary gold. Who cares about that? That's just Indians buying necklaces. Goldfix bottom line. India, like China, has moved decidedly to encourage gold ownership by its people through its fiscal decisions by lowering taxes for buyers, right? And its monetary policy by printing money to create inelastic demand. So will this continue? Yes. Think of it this way. If we are charging $2,700 for gold, it's costing them, assuming they're using dollars for this conversation, $2,800. And then the Indian government, and they're buying it. And then the Indian government says, I'm going to lower our tariffs so that it only costs $2,700 now. So we're lowering the tariffs to zero. Well, that's just going to increase demand. So tariffs implemented by a country throttle domestic demand. They reduce domestic demand. When you lower the tariffs, it's the same thing as lowering their price. And when you lower their price, you raise the world's price. Demand for gold is 2,800 here. Demand for gold in the rest of the world is 20. It's like you put them in a bubble and you stop them from buying above 2,700 because you're charging them an extra $100. Then when you drop that to 27, you make their demand $100 cheaper. And so the price here goes out, right? So 28 to 27 becomes 27 to 27 becomes 27.50. And that's very quantifiable. So gold is appreciating against the dollar because BRICS economies are no longer squeezing the life out of their own domestic demand because they're moving off of dollars. That's it. So they're like, have at it, boys. You want to buy some gold? Buy some gold. And it will continue. It's even more significant because this is what China did a year ago. China liberalized gold ownership. China linked accounts from savings to checking to gold buying. You know, it's kind of like you can buy gold in your regular checking account. Imagine if that could happen in the U.S. What would the price of gold be if your checking account was linked to a personal bullion account? Now, whether you get the gold delivered or not, I don't care about. The point is, you can buy gold directly. That would be like, buying stocks directly. And then what would happen to the price of gold? It would go up. And that's why they'll never do it. Okay, so that's my spiel on that. So my little note there is Indian policy manifest. Lowering tariffs lowers prices domestically and raises them internationally, which is what I just said. All right, news and analysis. Egon von Greyerz, I'm not sure how to say his name, I'm sorry, put out a story, Gold Will Rise by Multiples. It's a nice story, and we're particularly fond of it because he comments favorably about an article that we wrote, Fort Knox. If you open the vault up, there'd be nothing but half-eaten IOUs and maws, I think is the phrase we used. So that's a very nice call out by him to us there. AI versus reality, that's a founder's post describing a CIO at a fund in Connecticut describes that the blurring of AI to reality is going to do a lot of things to markets, and it gives you it's a thought piece, right? Yesterday, Goldman asked, will central banks continue to accumulate gold? And the answer is yes. Beware bullion banks out of the penalty box. I just mentioned that. That's our stories. Market news, Trumpism. Optimism, Trump optimism. We're trying to make a word up there. CEOs of the world's largest companies are more optimistic about the economy than they have been in years. The enthusiasm is being driven in part by the prospect of President-elect Trump's return to the White House. Okay, that's it, right? So small business optimism is going to go up, and it's very partisan oriented. So small businesses are going to, it's kind of like an animal spirits thing. Moving into geopolitics, Trump plays smartly. That's just a phrase that we said. Here's what happened. U.S. President-elect Trump said he had a very good talk with Israeli PM Netanyahu, according to Reuters. He added, it would not be pleasant if Hamas hostages were not released before he took office. I think that's a really smart play, because if Hamas doesn't release the hostages when he gets into office, that's a license for him to say, I warned you, you're dead. If they do release the hostages, he can take credit for it. I think it's a smartly played geopolitical thing to do, something I think he's actually pretty good at. And there's other stories in there as well. There's the premium, there's the report, there's Goldman, and we're also throwing in the Deutsche Bank CTA positioning that gave us that chart that showed oil, silver, copper, and gold. So you can take a look at that. Stay with us. We're going to go into the premium analysis for oil to give you the idea of the trade we're looking at. But let's look at the gold market first. Silver as well. Okay, for gold, you see that we broke out the Bollinger Bands again. We're inside the moving averages. The Bollinger Bands are telling me we're not done going sideways. 2,700 should be resistance, and 2615 should be support. Now I'm going to refine that, remove the Bollinger Bands, and say this. 2720 and 2560. So I think we're going to spend most of our time again inside these moving averages. But the Bollinger Bands are converging on the moving averages now, and that's too much of a coincidence for me to ignore. All right, looking at the market. All right, here's your ledge. There's been buying here for a while. I don't know who's buying that. I'm pretty sure this is macro discretionary with China or someone else like India buying it in this area. Look, I'll give you the bear scenario first. The bear scenario is this market's going down and they're waiting for the Fed statement tomorrow before they get their nerve to sell it again. Now, putting that in a same idea, but the reality of it is you have longs that are hoping for bullish news coming out of the Fed. If the Fed cuts and talks hawkishly, then longs will bail more. Whatever longs they're in the market will bail more. The question is, will banks let it fall? And I don't know. The bullish scenario is, and it's equally possible, the bullish scenario is the market is already pricing in the Fed hawkish talk. And I'm starting to believe that. And if the Fed comes out and says we're cutting 25 basis points and doesn't talk hawkishly, they cut 25 basis points and say, Merry Christmas. Well, we could rock it, And historically, the average rate of return for December gold, I don't rely on this, but it's not untrue. The historic rate of return for the next 2-3 weeks in gold is like 5% higher. That's an average. It's not something you go out and buy gold because while it's 5% higher on average, it has a range of minus 20% to plus 30%. So the question is, do you want to play a coin flip that could have a big move either way? I'm not saying to not get long. I'm not saying to not get short. I'm saying that if the Fed talks hawkishly and this market sells off, it's probably not a buy. If the Fed talks hawkishly and the market doesn't sell off, it's probably not a sell. If the Fed doesn't talk hawkishly, just you close your eyes and you buy it. and you probably will have a great next 2 weeks. Those are the three things that I'm looking at for gold. Now, we are in this situation right now where this looks really bad for silver, right? But I'm telling you that right now, let me see if I can get rid of this line here. Oh, there you go. Look, we've been here before, okay? And we screwed around underneath it for a couple of days. I would say this: if you're short silver, you stay short. If we get above this line, you cover, because we get back above this line, it's probably going to go right back to the 50-day moving average again. And if it gets above the 50-day moving average while this line is turned upward, well, then, and the Fed has come out and said, we're lowering 25 basis points, Merry Christmas. Then if I'm telling you to buy gold, if you're closing your eyes to buy gold, you're closing your ears and you're buying silver even more. That's just the way I'm looking at it. The other outside liars are something kind of China disappoints. I don't see that happening, but look for a double a double tsunami, right? The Fed could lower 25 basis points, and then 2 weeks later, China could say, you know what, we're going to do helicopter money, and that's always possible. So silver and gold, that's a situation. I'm flat. I've told you that. Butterflies going into the end of the year, and I still believe in that. But the next 2 weeks can be extremely volatile with an upside bias. All right, stay with us. We're going to do the premium oil comment, which is similar in concept to this, but with a little bit more finer point to it. Okay, so here's the oil chart. There are two lines of demarcation. There's a blue line sloping down. That's an estimation.